All right, rules for investing in good times and bad. President and CEO of Wilsey Asset Management joins us. Brent Wilsey, he's got rules that any investor can use. Good morning, Brent. Good to see you as always.
Good to be here. Thank you for having me.
Okay, I'm looking at your notes here. You've broken this down for us very simply into 5 principles. Let's start. We'll go right down the line. Number 1, never have cash just to have cash. What does that mean?
Well, and Jason, I do want to say that it's so important during times like this to have these rules, because if you don't have rules, you kind of go all over the board, you get emotional, you do the wrong things. That's why I came up with these rules. I've been doing this for 43 years now in the finance world. These rules help me stay on track. So the first one we talk about is never have cash, just have cash. People think, oh, I've got to have 20%, 30%, 40% in cash. Cash is the worst investment you can have. Now, maybe short term it feels pretty good because maybe things going down and you're not going down. But right now, inflation is around 7%. Cash is paying about 0.2, 0.5%. You're way behind the ball, so don't worry about putting 20%, 30% in cash. Cash is something to use just if you cannot find anything else good to invest in that's going to earn you better returns.
Okay, number 2, you don't have to have a high IQ to invest.
Yeah, I want to point this out to people because you don't have to be a rocket scientist to invest properly. It takes the rules. It takes the discipline. If you have average intelligence, you can do good investing, or make sure the advisor you have has average intelligence to make sure that they're sticking to a discipline and so forth, because it doesn't take a lot of knowledge to understand this. You have to understand the rules of the game. But again, you don't have to be a rocket scientist to do well when it comes to investing.
Okay. Number 3, volatility is not risk, and risk comes from not knowing what you're doing.
Yeah, people get volatility mixed up with risk. I say this all the time. Risk is when your money's gone forever, not coming back. Volatility is just the up and down movements. Now, it could be for days, weeks, months. It could even be for maybe a year or two that you have this volatility. That's okay. But the risk comes in of knowing what you're not doing, because of the fact that you're buying bonds and we just talk about cash. Don't worry about volatility. If you've done all your research to invest in good quality equities or good mutual funds that have good equities in them, that's okay. Stick with it. That's the knowledge that you've done. Depend on the knowledge. Don't worry about, oh my gosh, I'm down, 5%, 10%. That's okay. That's going to happen to you.
Okay, number 4, asset allocation is a false sense of comfort.
Yeah, this is one that Wall Street came out with because they want to have brokers just invest money for everybody. And there's some people that, frankly, cannot be good advisors because they really don't know what they're doing. So Wall Street says, we'll put some money into bonds, some money into stocks and cash and commodities. Well, that is a way to not do well at all. Right now, for the first quarter, bonds are down 6%. S&P was down about 6%. So you've not done very well by using asset allocation. And what it really does is it really hurts your investment returns longer term. We want to do an 8, 10, maybe 12% return on your investments. We've done that for many years. What you have to do is ride that, volatility and not try to reduce that volatility. It's going to happen. I tell people that all the time. We tell our clients, you're going to have losing months, losing quarters, even losing years from time to time, but that's okay. This asset allocation is a false insecurity that you're going to avoid that. All it really does is hurt your long-term returns.
Okay, and lastly, day trading and short-term trading is gambling.
This has been around since, I believe, the 90s, probably even earlier. People still don't get it. They still have that emotional feeling of like, yes, I want to, get this and trade and buy it. It's going to go up. I'll sell it next month. The meme stocks are a perfect example, and they're done by a lot of young people who have not learned the lesson yet. I continue to tell people, day trading, even short-term trading. If you're trading for a month, 2, 3 months, even 6 months, you're still trading. You're not going to do well long-term. When we look at investing, even someone coming to me that's 60, 65 years old, I know they still have hopefully 20, 30 years to live. You're still a long-term investor. Don't try to beat the market. The market will beat you up and chew you out every single time. It may take a while, but you cannot beat the market by day trading or short-term trading.
Okay, and how can our viewers get in touch with you, Brent?
Well, they go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. And Jason, you always ask me, we do have a workshop coming up this Thursday in Scripps Ranch at 6 o'clock. So we did one just for you.
Okay, appreciate it. All right, thanks, Brent. Good stuff. Appreciate it.
Thank you.